1 hour. That's all it took. 60 minutes erased nearly $6 trillion from the precious metals market. Gold plunged. Silver collapsed. And right now, thousands of traders are staring at liquidation notices, asking the same question. What just happened? This wasn't random. This wasn't bad luck. And if you don't understand what caused today's crash, you're going to get blindsided the next time it happens. But here's the part almost nobody is talking about. I've seen this exact setup before. Same structure, same panic, same forced selling. And what came after made early buyers a lot of money. So is this the end of the metals bull market? Or the opportunity people only recognize in hindsight? By the end of this video, you'll understand what actually triggered the sell-off, the one indicator most traders completely ignore, and what I believe happens next. Stay with me. This part matters. Welcome back to Economic Narratives, where we break down real market moves without the mainstream media spin. If you're new here, hit subscribe and turn on notifications, because what I'm about to show you can help protect your portfolio. And as we go, drop a comment with your biggest takeaway. I read them all. Let's start with the facts. Earlier today, gold was trading comfortably above recent highs. Silver was flying. Sentiment was euphoric. Analysts were calling for even higher prices. The trend looked unstoppable. Then the floor disappeared. Within an hour, leverage positions were wiped out. Stop losses triggered. Margin calls hit. And once that domino fell, the selling fed on itself. This is what a liquidation cascade looks like. Price drops trigger forced selling. Forced selling pushes prices lower. Lower prices trigger more margin calls. And suddenly, it's not a pullback, it's a spiral. Anyone who bought silver near the top expecting a quick breakout just learned how fast leverage can destroy an account. Here's what you won't hear on financial TV. This crash did not come out of nowhere. There were warning signs flashing well before prices collapsed. But most retail traders weren't watching the right thing. They were staring at gold charts. They were drawing trend lines on silver. They were checking RSI and momentum indicators. Meanwhile, the real driver of the move was screaming danger. That driver is the US dollar index, also known as the DXY. And if you're trading metals without watching the dollar, you're trading blind. The DXY measures the strength of the US dollar against a basket of major global currencies. When the dollar strengthens, gold and silver usually fall. When the dollar weakens, metals rise. This isn't theory. It's market mechanics. Gold and silver are priced in dollars. A stronger dollar means fewer dollars are needed to buy the same ounce. So prices drop. A weaker dollar means it takes more dollars to buy that ounce. Prices rise. It's an inverse relationship, and it works far more often than most people realize. Today, the dollar surged. And when the dollar side of the seesaw went up, metals got crushed on the other side. Professional traders saw it early. Retail traders saw it late. By the time most people noticed the red candles, smart money was already out. So why did the dollar rally so hard? There are 3 reasons, and together they created the perfect storm. First, the Federal Reserve. The Fed continues to signal a higher for longer stance. Rates haven't been cut as aggressively as markets expected, and inflation concerns are still in the background. Higher rates attract foreign capital. Foreign capital buys dollars. More dollar demand pushes the DXY higher, and higher DXY pressures metals. Second, China. Recent economic data out of China came in weaker than expected, and this hit silver especially hard. Silver isn't just a store of value. It's an industrial metal. Solar panels, electronics, EVs, and semiconductors all rely on it. A slowdown in manufacturing means traders fear reduced demand. That's why silver fell harder than gold. Third, political uncertainty. A U.S. government shutdown deadline is approaching, and markets hate uncertainty. After massive gains earlier in the month, traders didn't need much of an excuse to take profits. Political risk provided that excuse. One factor alone causes a dip. All 3 together trigger a flush. Here's another mistake traders make. They assume gold and silver move the same way at the same speed. They don't. Silver amplifies gold's moves, both up and down. When gold rises 5%, silver often moves 10%. When gold drops 8%, silver can fall 15%. That leverage cuts both ways. It creates massive upside during rallies, but it punishes mistakes brutally during corrections. If you trade silver, you have to respect that volatility. Now here's where things get interesting. We've seen this exact setup recently. Late last year, metals sold off hard right before month end. Panic was everywhere. People called the top. Sentiment collapsed. Then the following month delivered one of the strongest rallies in decades. Now look at today. Another sharp sell-off. Another wave of liquidations. Another spike in fear, right before the calendar flips. Same structure, same psychology. That doesn't guarantee what happens next, but patterns like this matter. Here are the 3 realistic paths forward. Scenario 1. The bull trend resumes. This pullback acts as a reset, and prices recover quickly. New highs follow within weeks. Scenario 2. The dollar continues higher, the Fed stays hawkish, and metals see another leg down before stabilizing. Scenario 3. Choppy, sideways movement that frustrates everyone, shakes out weak hands, and sets up the next real move when attention fades. I assign the highest probability to a recovery scenario, but only if the dollar cools off. Here's my personal view on the record. I believe silver regains the $120 level in the near term once political uncertainty clears and the dollar momentum slows. Not months from now, not later this year, sooner than most people expect. Hold me accountable. If you hold physical metals, do nothing. Physical is insurance, not a trade. If you're using leverage, today was your warning. Volatility plus leverage is how accounts get wiped. If you're sitting on cash, this is when preparation matters. You don't buy fear all at once. You scale in while others panic. While I'm watching closely, the DXY, Fed commentary, early February price action. Those will tell us everything. Markets transfer wealth from emotional hands to patient ones. Today, trillions change hands. Some people panicked, others prepared. Which side will you be on next time? Drop your thoughts in the comments. If this helped you understand today's move, hit the like button. Subscribe to Economic Narratives if you want real analysis without the noise. The crash already happened. What matters now is what you do next. I'll see you in the next video.